In continuation of lecture 1, we already have finished chapter 1 and chapter 3, and now we're going to see chapter 4. It talks about the time value of money, part 2. Okay, learning objectives are compute the future value of multiple cash flow. Previously, we have seen the future value or the present value calculation for the single cash flow. Right now, it's a multiple cash flow. Determine the future value of an annuity. That's a terminology. Later, we're going to touch on that. Determine the present value of an annuity. Present and future value, both we're going to cover. Adjust the annuity equation for present value and future value for an annuity due and understand the concept of a perpetuity. Distinguish between the different types of loan repayments, discount loans, interest-only loans, and amortized loans. See, we have seen few new terminology and concepts here. Multiple cash flow, annuity, perpetuity, and amortized loans. Build and analyze amortization schedules, calculating waiting time and interest rate for an annuity. Apply the time value of money concept to evaluate the voluntary cash flow choice. Summarize the 10 essential points about the time value of money. Future value of multiple payment streams. With unequal periodic cash flows, treat each of the cash flows as a lump sum and calculate its future value over the relevant number of periods. Sum up the individual future values to get the future value of the multiple payment stream. Let's see what does that mean. If you remember, this is called timeline. Do you remember this concept? We had it from chapter 3. And what does that mean? It means that, okay, we have a timeline here. It is how many years we have? 3, 2, it is 1, and it is 0. Okay. If we deposit 200 ringgit here, or 2,000, sorry, 2,000 here, 3,000 here, 4K here, and 5K here. Okay, how much we're gonna have at this point of time? That's the question. As you can see, that is important. Remember that these cash flows are not the same. They are called multiple cash flows. See, we have one cash flow at the beginning of the period, and we have second cash flow, third cash flow, and fourth cash flow. But these cash flows are in the different values, 2,000, 3,000, 4,000, and 5,000. Then what we are looking for, we want to know that after end of year 3, how much we're gonna have. Okay. For now, we're going to just use the basic formula and the most important formula in finance that we learn. What we are looking for, we are looking at the future value, isn't it? Present value, 1 plus I to the power of n. Okay, in this case, how much is your present value? Is 2K, 1.05. Okay, for how many years? We're going to bring it from here to 1 year, 2 years, and 3 years. That's why in here we have power 3. As you can see here also is power 3. The value would be this much. Okay, we do the same story for this value, 3K. 3 multiply 1.05, but for how many years it would be compounded? 1 year, 2 years. We're gonna put power 2. That's why you're gonna see power 2, and this is the value. Now what about here? 4,000. Okay, is 4K. Here is 3K. 4K, 1.05 to the power of 1. And this is 1, and this is the value. And what about the 5,000? 5,000 is already in year 3. You do not need to compound it. Then we're going to add all these values and going to get 14,822.70 cents. This is the value that you're gonna have after year 3, or at the year 3, I would say that. Okay, this concept is calculating the future value of the multiple cash flows, but these cash flows are not same. They are different in their values. Future value of multiple payment streams. Okay, see an example. Jim deposits $3,000 today into an account that pays 10% per year and follows it up with three more deposit at the end of each of the next 3 years. Each subsequent deposit is $2,000, higher than the previous one. How much money will Jim have accumulated in his account by the end of year 3? First thing first, okay, we need to see that here one of the points is saying that it's depositing the money when end of each of the period. That is important. Later we're going to talk about that. Okay, let's draw the cash flow streams and over the timeline. Okay, how much money he has here? 3,000. Here is 5,000, 7,000 and 9,000. $3K. Here is 5K. Here is 7K. And how about here is 9K. And see, with this formula, we are bringing 1, 2, 3. 3 years. Okay, we keep this amount. Okay, this one also we compound it for 2 years. We bring it to end of year 3. And this 7K also we compound it. Year 1. And this 9,000, okay, we put power 0 actually. It means that at the future value at the end of year 3. And this is the amount. Then we add all together and we're going to get the amount that we are looking for. And of course, there are alternative methods of doing this question. We can do it with the calculator, financial calculator, and some other methods. Okay. Future value of an annuity stream. Okay, what is annuity? We're gonna hear two terminology, annuity and perpetuity, okay? Okay, this is our regular timeline that we have. Okay, and what is annuity? This is called ordinary annuity actually, okay? 0, 1, 2, 3, 4, 5, 6. It can go more than 6 here. Just put an example. Okay, we are depositing fixed amount of money for certain number of years. Okay, this amount, for example, is 1K. Here is 1K. Here is 1K, 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 and 1K. Okay, see, fixed amount of money means that all the values are the same, could be 2K, 3K, any number, for the certain period of time would be deposited end of each period. Yeah, end of each period. Then we want to know that how much we will be having at this point of time. As you can see, this is also is the multiple cash flow. Okay, there are different ways of finding the future value of this multiple cash flow. We can refer to the previous method that we just did here. We can okay, bring this one to the future time 1, 2, 3, 4, 5, 6 times. We can compound it and plus that value to compound this one, keep it, and one by one until the end. We can do that method, or there is a shortcut. Okay, we try to follow the shortcut rather than doing that job, which is quite time consuming. We follow this formula, which is much more easier. See, this is what we are looking for. It means that if I know that the fixed amount of money that I'm depositing after or at the end of each period, this is fixed. For example, in our example was 1K, and I know the interest rate, and I know for how many years I'm depositing that fixed amount of money into my bank account or any investment. Then I can find the future value. This is called the future value of an annuity stream. Annuities are equal periodic outflows or inflows. For example, rent, lease, a mortgage, car loan, and retirement annuity payments. An annuity stream can begin at the start of each period. Annuity due, as it's true of rent and insurance payments, or at the end of each period. Ordinary annuity, as in the case of mortgage and loan payments. Okay, see the difference between annuity due and ordinary annuity. In finance, the convention says that all the payments, no matter regardless of cash inflow or cash outflow, happens at the end of each period. Okay, it means that either we borrow or lend, but we do it at the end of each period. This is a convention in the finance. And if this concept referring to the annuity, then if the payments happens at the end of each period, is called ordinary annuity. What if the payments happens at the beginning of each period? See, we pay, we use, 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 we pay, we use. Okay, this concept looks like if you have rented a house, is like that. Or the insurance, you need to pay, use, pay, use, pay, use. If the payment happens at the beginning of each period, it is called, see, annuity due. You need to read the question carefully in order to distinguish between annuity due and the ordinary annuity. Okay, let's see an example. Future value of annuity stream. Future value of an ordinary annuity stream. See, ordinary annuity, it means that the payments happen at the end of the period. Jill has been faithfully depositing $2,000 at the end of each year since the past 10 years into an account that pays 8% per year. How much money will she have accumulated in the account? Means that we are looking for the future value. See, this is one way of doing it, one by one. Every year we use the multiple cash flow as concept, and we take each single cash flow one by one to the last year. This is one way of doing it. Or rather than going through this troublesome method, we just use this formula, the shortcut. Okay, we know that how much has been deposited every month, every year, 2,000. Interest rate is given to us, 8%. And number of a year is 10 years, see? So easy, we're gonna get the future value of an annuity stream. And of course, it can be done by the financial calculator as well, or with the spreadsheet. Or we can refer to the table as well. Okay, this graph shows the power of the interest rate. See, if you have deposited $1, for example, at any year, see, if the interest rate is higher, 20%, see, your money gonna grow faster. And in here, the interest rate starts from 2.5% up to, for example, 20%. And see how your money gonna grow. Okay, right now we learn about the future value of annuity stream. Right now we can calculate the present value of an annuity stream. One of the usage of the present value of an annuity stream is for the retirement planning. To calculate the value of a series of equal periodic cash flows at the current point in time, we can use the following simplified formula. PV stands for present value equal to PMT, means the amount of payment, either cash inflow or cash outflow, which is fixed amount of money for a certain period of years. And the rest is interest rate and the number of years. Practical applications include figuring out the nest egg needed prior to retirement or lump sum needed for college expenses. See, as we can see here, see, this is a fixed amount of money that we are paying every year. Okay, if I withdraw the timeline, same as here, okay, 250 at year 1, 250 year 2, 250 year 3, and 250 year 4. What does that mean? It means that if I want to earn 250 at the end of year 1, 250 end of year 2, $250 end of year 3, and 250 at the end of year 4, how much do I need to invest right now with the interest rates of 8%? Okay, this concept, as you can see, is called annuity, and this is annuity, ordinary annuity. Okay, why? Because all the payment is happening at the end of each period. Okay, and then with that formula that we have seen, simply we can calculate the present value of the annuity stream. There is one example which you can go through. It has been done by this formula as well as the table and the financial calculator with a spreadsheet as well here. Okay, we already learned about the annuity due. Annuity, we know that what is annuity. Annuity means fixed amount of money would be deposited or would be received at the end of each period for a fixed number of years. If the payment or the transaction happens at the beginning of each year, each period is called annuity due. If the payment or transaction happens at the end of a period, is called at the beginning is called annuity due. At the end of a period is ordinary annuity. And what is perpetuity? Perpetuity is a cash flow stream such as rent, lease, and insurance payments, which involves equal periodic cash flows that begin right away or at the beginning of each time interval, is known as the annuity due. Okay, perpetuity is an equal periodic cash flow stream that will never cease. What does that mean? Okay, if you remember the annuity, the payments were happening in each year, fixed amount of money. But we had for some certain number of years, isn't it? But for the perpetuity, these payments happens forever, no stopping it. That's why the definition says a perpetuity is an equal periodic cash flow stream that will never cease. Means go forever. Okay, how to find the present value of all these cash flows? Because there are also multiple cash flows, but the amount is fixed amount, 2000, 2000, 2000, for example. Then how to find the present value is like that. That PMT means the payment divided by the interest rate. Okay, in here talks about the annuity due. If you remember annuity due, the payments or transaction happens at the beginning of each period. See the difference here? See at the beginning of each period, but the ordinary annuity, see, you use, you pay, you use, you pay, you use, you pay, you use, you pay. But for the annuity due, you pay, you use, you pay, you use, you pay, you use. You pay and you use. Okay, and in here also this formula tell us that if you want to calculate the present value of annuity due, this is the way. For the future value of annuity due, this is the way, and so on. And if you want to use the financial calculator, you need to do some adjustment here. Beginning and end. End refers to the ordinary annuity, and the beginning refers to the annuity due, which is there is a button that you need to do some adjustment. Okay, let's see an example for the present value of a perpetuity. If you're considering the purchase of a console that pays $60 per year forever, and the rate of interest you want to earn is 10% per year, how much money should you pay for the console? Do you understand the question? That you want to buy, you want to do some investment, that investment is paying $60 per year forever. Interest rate also in the market is 10%. Then you need to know that how much do you need to invest right now in order to get all those 60 end of each year. And based on the question, we understand that this is a perpetuity. Okay, if you remember it, present value of perpetuity was PMT divided by R. PMT is 60, R interest rate is 10%, then divide means $600. It's the most you should pay for the console. Okay, right now, many of us will refer to the bank and get a loan, isn't it? But bank has different repayment structure. 3 loan payment methods. Loan payments can be structured in one of these 3 ways. Discount loan. Principal and interest is paid in lump sum at end. See, these are 3 different options that some banks offer you. And you need to decide which one is better, which of these options is in your favor in order to pay back the money. Discount loan is principal and interest is paid in lump sum at end. Interest-only loan is periodic interest-only payments, principal due at end, and amortized loan is equal periodic payments of principal and interest. And now we're gonna see each of these options, that which one we're gonna be benefited more if we get a loan from the bank. First one, discount versus interest only versus amortized loan. Rosian wants to borrow $40,000 for a period of 5 years. The lenders, means the bank, offers her a choice of 3 payments structure. Pay all of the interest 10% per year, and principal, means that 40,000 in one lump sum, means all together at end of 5 years. You get a loan, you enjoy the loan for 5 years, but after 5 years you need to pay back loan. The principal is 40,000 plus the interest. This is one option that you have. Second option is pay interest at the rate of 10% per year for 4 years, and then a final payment of interest and principal at the end of 5th year. Means each year you just pay interest for 4 years. End of 4 years means that year 5, then you pay the 40,000 plus extra interest. And the option 3 is pay 5 equal payments at the end of each year, inclusive of interest and part of the principal. Means end of each year you pay a bit of interest and a bit of principal until end of year 5 that all the principal and the interest would be paid. Right now we want to do some calculations, see which of these option is better. Under which of the 3 options will Rosen pay the least interest and why? Calculate the total amount of the payments and the amount of interest paid under each alternative. Okay, method 1. Since all the interest and the principal is paid at the end of 5 years, we can use the future value of a lump sum equation to calculate the payment required. Okay. We got a 40,000. Yeah, we got a 40,000 here. We got the 40,000, 40K. And we want to know that how much is the interest rate over this one, yeah, and plus the lump sum. Then we can just simply use this formula that we have. Present value is 40K, interest rate 10%, and number of year 5. Then it means that in this method, after 5 years, we need to pay 64,000. And out of this 64,000, the 40,000 is the principal. It means that if we deduct it from the amount that we already paid, this is the amount of interest, 24,000. Okay, method 2 was interest only loan. It means that every year we're just going to pay interest, 10% over the 40,000. Okay, it means that every year we need to pay 4,000. Okay, in 5 years, how much are we, in 4 years, how much are we paying? 60,000, isn't it? And at the end of year 4 or end of year 5, we're supposed to pay the principal 40,000 plus another 4,000. That's why it is 44,000. Altogether, we're going to pay 60,000. And if we deduct the 40,000, the principal, it means that we are paying 20,000 interest rate. In the previous method, we are paying 24,000 interest. In this method, we are paying 20,000 interest. Of course, between option 1 and 2, option 2 is better for the person that gets loan. Okay, let's see option 3, which is called amortized loan. Number of years is 5, interest is 10%, present value is 40,000, future value, you don't have anything, and the amount, okay, we're supposed to pay is 10,551.9. Okay, where did we get this number actually? What is this? When we get a loan, then we need to pay how much? We need to pay 5 equal payments to the bank, isn't it? In here, I got 40K as a loan, but I need to pay some installment to the bank. Does this scenario look like an annuity, ordinary annuity to us? Yes, this is an ordinary annuity. If you remember, the ordinary annuity formula was present value was PMT over R, 1 minus 1 divided 1 plus R to the power of N or T, and close this part. Did you remember this formula? Here is. Sorry for my handwriting. I'm not really used to this pad. I can't really write properly, by the way. Okay, we have this one, we have this one, we have this one. This is what we are looking for. If you plug in the numbers here, that is what you're gonna get. Yeah, okay. Then, okay, to how much is your total payments? You're gonna pay 5, isn't it? 5 multiple the yearly payment is this much you're gonna pay in 5 years. And how much did you loan? 40 minus this 2, 12,000 is the interest you're gonna pay. When we compare it here, see, in the first method you would be paying 24. Wow, it's too much. Second method is 20, and third method is just $12,759 as the interest. Of course, a logical person gonna go for amortized loan, which gonna pay a lesser interest. But from the banker's point of view, of course, bankers gonna prefer this method. Why? Because they can collect more interest. Okay, amortization schedules that we can schedule it. We can, whatever calculation that we already have done somewhere here, we can come up with a table for it. Let's see how the table works. Tabular listing of the allocation of each loan payment towards interest and principal reduction helps borrowers and lenders figure out the payoff balance on an outstanding loan. Procedure: compute the amount of each equal periodic payment. How are we going to do that? With the ordinary annuity formula that we already have covered. Calculate interest on unpaid balance at end of each period. Minus it from the payment, PMT. Reduce the loan balance by the remaining amount. And continue the process for each payment period until we get a zero loan balance. Yeah, these three steps helps us to get the amortization schedules. Okay, we are referring to the previous question. Prepare a loan amortization schedule for the amortized loan option given in example 6 above. What is the loan payoff amount at the end of 2 years? Okay, with the formula we already have covered, we know that every year we need to pay this much. Let's put it in the table. See, how much we got? We got 40,000 as a loan. And see, this much is fixed all over the 5 years because the duration of the loan was 5 years, isn't it? This is fixed. But see here, at the beginning we got 40K as a loan. Okay, this is a payment. And how much was interest rate? Actually, 10% of the 40,000 is 4,000 interest, isn't it? Okay, we are paying this much per year. Means 4,000 out of this much is interest. We deducted, the remaining is principal, 6,000. This 6,000 would be deducted from this 40,000. The remaining is 33.448. Okay, we bring it here. Then we do the same story. Okay, 10% of this is 3,344. The interest that we are paying. This much would be deducted from the payment. The remaining is the principal reduced. We deduct this much from the beginning balance. The remaining is this much. As you can see, the beginning balance is reducing. And of course, the interest that actually you are paying on the beginning balance is reducing. It means that out of this payment, which consists of principal plus interest, see, when you are getting closer to the end of a duration of the period of the loan, the amount that you're paying as the principal out of this money is much more than the amount that is paid for the interest. This table is called amortization schedule. Okay, waiting time and interest rates for annuities. Problems involving annuities typically have 4 variables. If you remember the formula, we have 4 variables. What does this part mean? It means that by having 3 variables, we can find the unknown. And we can have any of those 3 variables and find the other one. So in here, it's just giving you some examples. You can just go through it by yourself. Okay, part 4.9 talks about 10 important points about the time value of money equation. Let's see one by one. Amounts of money can be added or subtracted only if they are at the same point in time. It means that we need to do some time travel in order to be able to do some calculation or make some financial decision. We cannot simply add the present value to the future value. No. We need to bring the future value to the present value and add it with another present value. Or we need to take the present value to the future value and add it to the other future value. The timing and the amount of cash flow are what matters. Of course, the timing matters because some of the cash flows, either cash inflow or cash outflow, can happen 10 years in future, 5 years in future. Then, of course, we need to bring in the interest rate and the time in our calculation. Why? Because In future, usually and mostly, the purchasing power or the value of the money drops. Then we need to incorporate it in our calculation. It's very helpful to lay out the timing and amount of cash flow within a timeline. Timeline should be your best friend whenever you're doing any financial calculation. Present value calculations discount all future cash flows back to current time. Future value calculation value cash flows at a single point in time in the future. An annuity is a series of equal cash payments at regular intervals across time. This is the definition for the annuity. You need to know that. The time value of money equation has 4 variables, but only one basic equation. And so you must know 3 of the 4 variables before you can solve for the missing or unknown variables. There are 3 basic methods to solve for an unknown time value of money variable: using equation and calculating the answer, using the time value keys on the calculator, and using financial function from a spreadsheet. There are 3 basic ways to repay a loan: discount loans, interest-only loans, and amortized loan. And we noticed that if we pay a loan under the amortized loan, the amount of interest that we are paying is much more lower. Despite the seemingly accurate answers from the time value of money equation, in many situations, not all the important data can be classified into the variables of present value. For example, time, interest rate payments, or future values. Okay, from here onwards, guys, you have many questions or problems that you can refer to the notes and you can do it by yourself. I just try to recap for you. Okay, see, we have a few different scenarios. If you have a single cash flow, okay, it means that the cash flow either can happen in the future time or can happen at the present time. Okay, here is future value, here is future value, here is present value, here is present value. Okay. What does this mean? It means that if I want to have this much money in the future value, how much do I need to invest right now? This is called single cash flow. Okay, this is the basic formula, 1 plus I or R to the power of N or T. Then this is what we are looking for. Okay, in this case, if I know that, okay, if I invest this much, I want to know that how much this money gonna grow in future time. We're gonna use the same concept. Okay, next one is the multiple cash flow. Multiple cash flow scenarios, which we can have unequal cash flows. We can have annuity, which annuity can become ordinary annuity, and annuity due, and we can have perpetuity. Okay. For example, under the multiple cash flow, we can have many different cash flow with unequal cash flows. Okay. Future and the present. This one could be 10, this one could be 5, this one could be 15, this one could be 8. See, if you're looking for the future value, then we can take all these values to the future, compound them, and we're gonna find if we invest all this money in every year, then how much we're gonna have in the future value. How it works, a simple formula that we already have is 1 plus I PV, for example 10, multiply 1 plus I to the power of 1, 2, 3, 4. This is 10. Okay, let me write it properly. 10, whatever the interest rate is, to the power of 4 plus 5, 1 plus r to the power of 3 plus 15, 1 plus r to the power of 2 and plus 8 to the power of 1 plus r to the power of 1. Then we're going to find the future value. And we can do the same calculation in order to find the present value actually. Okay, another one is annuity. Yeah, this is all about annuity. If the transaction or cash flows happen end of each period, then we call it ordinary annuity, which the present value is C, or the cash flow you all see. If you remember all the cash flows, the amount is fixed. 1 minus 1 plus r, or I to the power of n or t. Okay? And of course, you can find the future value of the annuity, which I don't remember the formula, but you can refer to the notes. And over the annuity, payments can happen at the beginning of each period. 0, 1, 2, 3, okay? Can happen at the beginning of each period. Which, the same story, we can find the present value and the future value of the annuity. And the last one is perpetuity. It's like an annuity, but see all this C means cash flows. But this one, the time and the payment goes until up to future. Then how to find the present value of the annuity is the payment divided by the R. Okay. We are done with chapter 4, guys. All the best, and I will upload it in your Blackboard. Thank you very much.